Well, good afternoon and welcome to HIROC's weekly webinar where we will talk about what we see happening in the global economy, in financial markets, and in the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We do invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously, which is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HIROC, is also with us, as is our financial planner and wealth forecast specialist, Bianca Tomlinson. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. As we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having tactical perspective to investing is even more important in 2017 because of the even greater levels of uncertainty imposed on us by a host of developing factors. Inflationary expectations have been rising, but core inflation has only been growing modestly so far. While other central banks are more cautious at the moment, the U.S. Federal Reserve raised rates by 0.25% on March 15th, and it is expected that they will likely raise rates 2 more times over the course of the year. It is expected that earnings will grow at an approximate rate of 9.8% over the course of 2017. This has been lowered from 11.5% growth rate at the beginning of the year. However, valuations are at 14-plus year highs, putting stock prices about well above the prices of the 10-year average valuation. At the same time, economic growth has not kept pace with stock market advances. Well, the Trump agenda appears to be running into political hurdles. Brexit is finally being initiated, and French elections are upcoming in April and May. Meanwhile, protectionism concerns are rising. This week's meeting between President Trump and President Xi could be telling. Now, one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds in the U.S. and in Canada. And Paul, did you want to talk about any of the correlations or any changes in the correlations this week?
Well, no, there's really been no changes since last week to speak of. Government bonds have been performing very well over the past week. We've had a pretty stout rally where rates have gone down, bond prices gone up. But actually today they're just up a snick in both Canada and the U.S. But the correlation to stocks, as you can see, has not really changed much at all.
Okay, great. Thank you. When we began our advanced approach to portfolio management back in 2015, we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add additional value to client portfolios by reducing risk and maximizing risk-adjusted returns. And we wait for opportunities to buy assets. So the benchmark equity index that we use for comparison has returned close to 15.5% from this time last year and only approximately 5% annualized since this date 2 years ago. And this emphasizes the volatility over this time period. Meanwhile, the benchmark bond index has barely had any positive return over the last couple of years, leaving investors with a greater weighting of bonds with little to show for it. Well, each week I look at how short-term and longer-term returns have progressed in our benchmark ETFs for comparison to client portfolio performance so we can continue to monitor our clients' progress. Each client will likely have different starting points and may have different allocation weightings. So for newer clients, there may be some differences in their personal portfolio returns, especially in the short term. So we want to focus on more longer-term returns because that, in the end, is how we will be judged. Achieving your long-term goals. It is the end of the first quarter of 2017, and client reports will follow shortly, accompanied by this table so that you can make your own comparisons. And as we look at longer-term HIROC client performance, the one-year performance here after fees is ahead of the benchmark, but little change from last week, while the benchmark is in fact lower by more than a percentage point, which highlights how our client portfolios have a lot less volatility than the benchmark, certainly in the short run. And this is clearly a result of our tactical approach. As for the long-term performance of about 4.5 years, it speaks for itself, well ahead of the long-term benchmark by close to 3%. That is our success, which in turn is our client's success. In my blog this morning, I highlighted the difference between absolute returns and risk-adjusted returns. What is most important is that the actual HIROC private client return per unit of risk taken, which on an apples-to-apples basis significantly outperforms the 60/40 comparative benchmark. Now, graphically, you can see that the absolute return for the HIROC private client is higher and the risk taken significantly lower. And as I know you're all aware of, historical returns are no guarantee of future returns, but at HIROC, as you also know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy, and our forecasts for your net worth into the future are up to date and heading in the right direction. We are watching the inflation story closely. As all central banks have a mandate to maintain price stability, we are focusing on inflation as a key to determine if and when interest rate policy may change. While total inflation has been rising on a global scale recently, core inflation continues to remain relatively subdued, although it is inching higher. Most recently, the Bank of Japan, Bank of England, and European Central Bank have kept rates steady and monetary policy unchanged. And with the uncertainty surrounding the French election, it is not likely that the European Central Bank will make any significant adjustments to monetary policy until the dust settles there. One of the reasons for a higher total CPI had been the steady improvement in oil prices. Oil prices, though, dropped by about over 10% a few weeks ago, but now they are back above the $50 mark over the last week. Now, this volatility is why central banks like to take out the energy component from their inflation calculations to get a better read on the more stable core inflation. Commodity prices have basically moved sideways since peaking last July, which may limit that reflation argument that we've all been hearing about lately. Well, last week we noted that soft data, like consumer confidence, was definitely rising. But the hard data, follow through consumer spending, is not, according to the latest from the U.S. Commerce Department. And this was highlighted by yesterday's auto sales data, which were significantly below expectations. So expectations for 2017 first quarter GDP in the U.S. is tracking at levels that are well below what was expected at the beginning of the year. As a result, longer-term U.S. bond yields, as Paul mentioned earlier, have been moving lower, and the yield curve in the U.S. has been flattening. Now, a flattening yield curve where 2-year bond yields, the ones in gold, rise to intersect with the 10 and 30-year bond yields in green and purple, and has historically indicated that a recession will follow soon thereafter. Now, if the Fed raises interest rates, and they are expected to do so, as I said, at least 2 more times this year, the yield curve could flatten further. Now, at the same time, a slowing U.S. economy is moving 10 and 30-year bond yields lower, and we do want to pay attention to what bond markets are telling us because they do lead all financial markets. After reaching a record high in January, total Canadian exports fell 2.4% to $45.3 billion in February on lower volumes. Now, year over year, exports are up 4.4%. There were lower exports of farm, fishing, and intermediate food products, aircraft, and other transportation equipment and parts, as well as consumer goods. In February, exports excluding energy products were also down 2.4%. So despite a good January GDP reading, the export data throws a shadow on future economic growth, and bond yields in Canada are declining as a result. It is unlikely that the Bank of Canada will change its interest rate or monetary policy at its next meeting. On the debt watch, we have been pointing out the risks of record amounts of global debt. With rising interest rates, this puts increased pressure on debt servicing. We know that Canadian household debt is at record highs. Now, U.S. household debt has jumped as well to higher levels than they were at in 2008. Well, as for stock market value, as we discuss each week, expected earnings for 2017 have been reduced from an 11.5% year-over-year growth rate at the outset of the year to 9.8% at this moment. For the first quarter, earlier expectations of 12.5% year-over-year increase in earnings have been lowered to 9.1%. And looking forward, prices continue to outpace expected earnings. With lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.6 times, close to its highest level in 14 years, while the 10-year average is at 13.9 times. This means that earnings will have to grow by about 20% more than currently expected to bring the ratio back to its 10-year average. Or, on the other hand, the S&P 500 will need to correct by about 20% or some combination of the two. At the moment, we don't want that kind of risk in our client portfolios. Another metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. And yesterday, as Paul discussed in his blog, stock prices are way ahead of U.S. economic growth, which, as we mentioned earlier, appears to be stalling. So at some point, something does have to give. And that might spell a peak in the cycle, as emotions have been running rather high. Well, on the geopolitical front this week, volatility on stock markets was up a little bit, but it is still relatively low compared to the uncertainty index on global economic policy, which has risen close to new highs. Now, in the U.S., the House of Representatives lawmakers hope today to release a new Trump administration-backed version of the health care bill. They had to abandon the one that they initially started with last month, but Republicans have very little space on their calendar to hold a new vote this month. They are scheduled to begin a 2-week recess on Friday, and then they return. They'll have to. They'll only have 5 days to pass a spending measure to keep the government funded after April 28th. Mark Meadows, the chairman of the hardline House Freedom Caucus, which helped block the last health care bill, said Monday that he hadn't seen the administration's new proposal in writing. Meanwhile, there is little new on tax reform and deregulation, although today President Trump announced a $1 trillion infrastructure spending proposal. We'll have to wait, though, some time until that is looked at in Congress. On the Brexit front, the European Parliament is to vote on tomorrow on a resolution that sets out the Assembly's terms for an European Union UK Brexit agreement. The Parliament's approval of a deal is a legal requirement for an orderly UK departure from the European Union. And voters will cast their ballots in the first round of the French presidential election on April the 23rd. Interestingly, French intelligence have previously warned about the risk of a Russian cyber attack in support of Ms. Le Pen, who met with Vladimir Putin in Moscow last month. And President Donald Trump and China's leader Xi Jinping meet this week for their first summit. Success hinges on whether aides have created grounds for a working relationship. White House officials say Mr. Trump will press Mr. Xi to agree to a results-oriented relationship with action on two significant issues: one, curbing Chinese exports to shrink the U.S. trade deficit, and policing Chinese companies that trade with North Korea to hobble Pyongyang's nuclear and missile programs. Mr. Xi's priority is apparently to stabilize relations as he focuses on assuring his dominance in a Communist Party leadership reshuffle later this year, Chinese political insiders have said. A crisis in U.S. relations, especially a trade war that slows China's economy, presents one of the few threats to his authority. So here at High Rock, with all the upheaval happening around us, we continue to monitor the event risk, which we think is high, and we monitor price valuation, which we also think is too high. And we will add or reduce holdings in our models as opportunity does present itself. We will also maintain our disciplined approach to our strategies with skill, competence, and continued deep levels of research, making our tactical approach add value and reduce risk so as to give us all the best possible risk-adjusted returns. And usually at this point, I ask Paul if he has anything in particular he'd like to report to us.
I will give a quick comment, Scott. Thanks. One thing I forgot to mention a few weeks ago now, we actually sold out some of our REITs. We held effectively retail REITs. We sold out 2 of them, and the reason being is that I think there's a pretty big theme developing here. U.S. retailers are coming on hard times, and I'm not entirely sure if it's just due to online purchases or it's something more sinister with regards to the consumer. But especially department stores are getting absolutely annihilated down there. And up here as well. I mean, Hudson's Bay, HBC, is getting hit down pretty hard as well. So with that in mind, we did trim out of 2 of our retail REIT positions, which I think was kind of strategic. The other thing I'm looking at on that theme, along with the consumer and retail sales, especially in the old school bricks and mortar buildings, is auto loans. So I did a fair bit of research this morning. Morgan Stanley gave me a very complicated piece, but subprime auto loans, all these asset-backed securities have been jammed with these subprime auto loans, and the quality of the loans has gotten much more. There's a much bigger percentage of subprime in all these asset-backed securities than there was even 6 months ago. I'm watching that, and as we saw yesterday, as you pointed out, U.S. auto sales were dramatically lower than they were expecting. So again, keeping one eye on the consumer for sure at all times here. And away from that, not a lot of changes within the portfolios. We still think that we've had a lot of our high yield, or pardon me, our energy play has been through high yield bonds over the past year and a bit. Some of those bonds have naturally been called away from us by the issuers, so we were pleased with the performance of those. They really worked out well, especially on a risk-adjusted basis. And now we've done a little bit of layering into some of the underlying equities, which have been hit down pretty hard. So I think there's better value in some of these energy stocks. So that's where we're spending more of our time right now. That's it.
Thanks, Paul. Yeah, if anybody listening live has any questions, please feel free to throw them our way at the moment. Okay, no live questions, but as always, we want to encourage anybody who has any questions to feel free to email them to us. We certainly are thankful that you take the time out of your busy schedules to tune in. We will be back with our next update next Tuesday, but until then, actually next Tuesday I have to do a course. So we will be back in 2 weeks' time. So I'm glad I caught that one. So in 2 weeks, we will have our next webinar. But until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great couple of weeks.